Hello and welcome. Let's welcome in our first guest on the show. Markets are looking in pretty strong in and around the 18,000 level. Ajay Vora is now with us, fund manager at Nuwara Asset Management Company. Of course, he heads the 3CAT AIF fund that they have. Ajay, thanks so much for taking out time for us. Can you just start by telling us what's your perspective on the market with the sort of broader market sell-off that you saw in the last few days? You think it's making the markets look healthier?
Good afternoon, and thanks for having me. So, actually, if you look at it, how the markets generally behave in the medium term, it's mainly discounting different narratives. And if you look at at the start of the year, which is April, at that time markets were fearing aggressive rate hikes, and therefore in that particular quarter, we saw almost 10% correction because market was trying to adjust to the aggressive rate hikes. And then as market realized that the rates have gone too high, and therefore inflation will likely ease off. Market took comfort in that, and therefore we saw a very sharp rally. So these are the two narratives. I thought of giving a bit perspective on that. These are the two narratives which had played out, and now as we are settling in with the higher rates and inflation also cooling off. I think the theme which will play out from here on is that since rates will be higher for longer, the growth will take a knock, and therefore in this entire rally, you must have seen that also from the lows, markets have rallied by almost say 20% odd, approximately. It is the value trade which has done pretty well, and therefore the PSU banks, commodities, they have rallied by anywhere from 40 to 70%. So growth is definitely likely to slow down globally as well as in India. And on top of it, we have seen this re-emergence of the COVID fear, although there is no concrete data to show that in India we are going to see a significant rise. But my sense is that adjusting to that growth, slower growth, we are seeing this kind of a correction over last 2 days.
Right. So, corrections, of course, will be a part and parcel. Markets will keep factoring in higher growth, lower growth, or better growth. But what is the sense that you get? What should be the trading style going into 2023? Should it be value? Should it be growth? Should it be neglected sectors, which actually saw a rally in 2022?
So my sense is that since as we discussed that growth will definitely slow down, one should stay away from expensive growth stocks, and therefore I feel that there are still certain pockets in the market where the order inflow, for example, the entire cap good space, infra space, there we are seeing a decent growth, and valuations are pretty reasonable in few names. So that is one theme which can play out pretty well. We are also pretty bullish on the private sector banks because I think that they are still in the sweet spot, considering the the credit growth and the benign asset quality, and also the ownership. Actually, if you look at it, the FI ownership in banks is still pretty low versus what they used to have earlier, and that is also one comfortable space we feel that is looking good for next 1 year or so. And if you look at generally the broader markets, this year, which is FY23, we'll end with Nifty EPS of somewhere close to say 810 odd, and maybe FY24 will be closer to 920 odd. So at 18,000 odd, 20 times multiple, I think is pretty fair, and especially in an environment where rates are higher, valuation expansion looks unlikely. So my sense is that from year on. This year we had a 10% growth in Nifty EPS. Next year again we'll be somewhere around 10-12% growth, but you will have to find certain pockets where growth can be 15-18% with reasonable valuation. That can be a good thing.
Right. How would you look at the new age company, the way they have fallen, the way they have, seen a derating? Earlier there was a huge rush, and now there seems to be a huge rush of supply.
So I think it is very clear that in a high rates environment, cash flow is the key, and free cash flow is very important rather than just looking at the price to sales multiple. And I think it will still take some time for all these new age companies to generate free cash flow. Basis that we have stayed away from this theme, and we would continue to stay away.
But these companies offer growth. There is no doubt about it. These companies have a disruptive model. Some of these companies, also do provide some comfort as far as majority of their fundraising is done. Are you looking at them, or you're saying that they're still pretty expensive, and that's why let the market find its own price?
No, we are definitely evaluating them every now and then. But as I said that, I think the valuations are still pretty high. Although, as you rightly said, they are offering decent growth. But my point is that, my only thing is that, in 2008, the global financial crisis, the large part of the bubble got formed into, all those MBS and, all those subprime kind of an assets. This time, I'm not saying a bubble, but a definite euphoria has been created on the private market side, and therefore, I feel that one has to wait and watch where things settle. And basis that I'm saying that although growth is there, but for us, when we are investing, free cash flow is extremely important. So that is something which we'll monitor every quarter.
I mean, Ajay, it's always nice to compare it with the sort of subprime that you saw, but that had a cascading effect. These companies don't have loan. These companies doesn't have a cascading impact. It's just largely PE investments, and a lot of PE players can shut down. PE players, may lose their job if something goes down on this. But why do you think this can be compared to that sort of issue of loan that you're talking about?
No, so the point over here is that if you look at the amount of the liquidity which the world has seen over last say 10 years or so, and then if you compare it and look at the data, a large part of that has gone into these kind of startups globally, and a very clear indicator and something which is very evident is the way you have seen so many startups value getting eroded in Nasdaq and in US especially, or even in the the Chinese market. So my point is that these all kind of euphoria which gets created takes some time to settle down. So I'm just not trying to compare the subprime with the private market. What I'm trying to say is the liquidity flow which took place into subprime. To some extent, it is similar to what it has taken place this time in the private markets.
All right. In terms of heavy asset owners, the likes of L&T, BHEL, power companies, infra companies, are you a fan over there? For 12 years, they've had that issue of subprime and loan not coming to them. You think finally they have found their way in terms of how to grow?
So, not to talk about any specific company, but we like this entire cap goods and infra space because if you look at the data, the private capex in the country has now reached at a level what we had seen in the 2003-2008 level, 8 period. So, therefore, we feel that after a fairly long time, almost after 15 years, the private capex has emerged in a very big way, and that also is very broad. So across all sectors, be it steel, cement, chemicals, pharma, and lot many other sectors, we are seeing a decent announcement by the companies on the future capex. So that gives us a lot of confidence for this entire cap good space in terms of their order inflow, and also with the raw material prices coming off, which were pretty high earlier, impacting their margins. We can see some sort of tailwind there as well. So I agree that the valuations are a bit high right now, but since the cycle can be a pretty longer one this time, one can definitely look at a decent name and participate into this theme.
In terms of capex, I can understand you cannot be stock specific, but you can tell us whether you like cap goods, whether you like power, you like proper infrastructure, ports, roads. How would you essentially look at it?
Yeah. In terms of the sectors, we definitely like the cap goods space. And within infra, you don't have many options. But I would say that there are few companies which are within the infra space are available at 2 times, 3 times EV to EBITDA. So that is something which is looking very interesting. We are on the utility side, power. Also, we are positive over there because stocks are trading at 1 time price to book. And another way to play is the entire cement space. So that is also looking very interesting with a lot of consolidation happening there. And raw material prices again there has come off in terms of pet coke prices. I think that supply growth is unlikely to be very strong. Whereas if the demand till the 2024 election, if that surprises, then that sector also has a lot of upside from it.
Consolidation. You think consolidation has happened into smaller sectors as well? The likes of sugar, paper, any of the company that we speak to are pointing about pricing power being slightly better, consolidation and debt being over. You think these smaller sectors are also interesting, where over last 10 years you have seen humongous amount of M&As?
So we don't closely monitor these smaller sectors like sugar and paper and all. But one thing is pretty sure across, corporate India, be it the larger companies or the smaller companies, the deleveraging theme has played out pretty well over last 2 to 3 years. And therefore, if you look at it, once the demand really picks up, you have the operating leverage as well as the financial leverage. So broadly, I feel that, be it whichever commodity sector, if the deleveraging has happened and if you're looking at decent demand going forward, that sector will definitely offer decent upside.
All right, sir. Thank you so much, sir, for taking out time for us. Always good to get perspective.
Thanks a
On
lot.
that note, we're taking a break, coming back quickly, leaving you with Nifty looking solid on the higher side right from the word go since morning, has been stable so far.